That's the hard truth about why 98% of new investors fail. And I'll cover the most common mistakes. And first of all, let's demystify something. Some people will say that every mistake is a good thing, but there's a huge difference between a necessary mistake and an avoidable mistake. A necessary mistake happens when no one in human history has ever done what you're doing. So there's no way to know in advance whether your decisions are right or wrong. In these cases, the only way to find the right path is by eliminating all the wrong ones. In other words, you figure out 1,000 ways not to do something. But here's the catch. This kind of mistake is rare. The odds of your mistake being that groundbreaking are incredibly low. Then there's the avoidable mistake. An avoidable mistake is one that thousands of people have already made before you. And if thousands of people have made it, it's a common mistake. If it's a common mistake and it's avoidable, then it's a mistake that already has a solution. The moment we stop looking for insights from people who have already faced the same problems we're going through, we start making mistakes that could have been avoided. Most of the mistakes investors make are expensive, are avoidable, and worst of all, we don't get rewarded for mistakes we could have avoided. So, how can we avoid avoidable mistakes? By learning from those who have already been through them. Now you get this, we can move to the video. And wait, hold your like, hold your comments, you don't need it now, but when you finish watching, if you like the content, don't forget to interact, okay? It's pretty important for me, I swear it. The first mistake every investor makes is not having an investment strategy or methodology. There's a study by Vanguard, one of the world's largest asset managers, that shows a surprising insight. Most of an investor's portfolio returns don't come from picking the right stock or any other specific asset choice. In reality, your returns depend more on how you allocate your investments than on the assets themselves. Take a look at these numbers. The numbers on top represent the percentage of diversified funds. The numbers below show how much of their returns came from diversification. Here's what the data reveals. In the US, 91.4% of fund returns were due to having a structured investment methodology. In Canada, 88.3% of returns were explained by portfolio structure. In the UK, 80%, in Australia, 89.9%, and in the US, the pension funds, which are designed for long-term retirement security, 93.6% of returns came from portfolio structure. And what does this mean for you? Your investment strategy and philosophy should not change as quickly as the market does. The success of your investments depends on having a methodology and long-term consistency. So when the market gets volatile and emotions run high, remember this: stick to your strategy. I've already made some videos on the channel where I talk about investment strategies, and you can click on the card above to watch. Also, this is an invitation to follow me and activate the bell, because I will probably release even more videos about proven and applied investment methodologies. The second mistake I see many investors making is not rebalancing their portfolio. I understand that you diversify your investments and expose yourself to an asset class that you believe makes the most sense for the current market conditions. But when you don't rebalance, you are literally losing money. So think about this. Let's say you have $100 to invest, and invest in two different classes: asset 1 and asset B. In the first year, asset A goes up 100%, while asset B drops 50%. Now, asset A is worth $100 and asset B is worth $25. So your total is $125. But in year 2, asset A drops 50%, now worth $50, while asset B goes up 100%, now worth $50 as well. What happened here? Both assets went up and down, and at some points you even made money, but in the end your return was 0%. Why? Because you didn't balance your portfolio again. Now look at what happens if you rebalance your investments. In the first year, asset A increases 100%, now worth $100, and asset B drops to 25. So your total portfolio is now worth 125. However, your portfolio is now unbalanced, and you need to have 50% in each asset. What do? You sell part of asset A and buy more of asset B. Now you have $62.50 in asset A and $62.50 in asset B. If in year 2 asset A drops 50% and asset B goes up 100, you don't go back to 100. Now you have 31.25 in asset A and 125 in asset B. It totals 156.25. That's a 56.25% return with two assets that individually didn't grow. They just canceled each other out. Do you see why rebalancing your investments makes sense when your portfolio structure changes? This is the logic you need to follow. The third mistake is neglecting the generational investment. Here in my country, it is very common to see people complaining about not being born with an inheritance, with a fund, but I have also never seen these people doing anything for their children or grandchildren. It's always someone else's fault. It seems that no one is prepared to take responsibility, and in my family, I decided to take responsibility. I was not born with $1 billion inheritance, but I am building this legacy for my family. And when you decide to grow up, be an adult, and take responsibility in the toughest way possible, your financial life is blessed in the best possible way. Now, if you are not willing to take responsibility, if you are the crybaby who wants to make more money, but to make money and hide from the world because thinks that no one else deserves your efforts, know that you will not build anything. Because long-term vision is a non-negotiable principle of investing thanks to compound interest. And you only stay consistent in the long run if you have responsibility and purpose. Warren Buffett invests for generations, not years. See? If you invest $10,000 at 12% per year, here's what happens over time. In 5 years, you have $17,000. In 25 years, you have $170,000. In 50 years, you have $2.8 million. And in 80 years, following a long-term family investment mindset, you and your family could have $86 million. Can you grasp the magnitude of this? A single investment of $10,000 today could secure financial stability for all future generations of your family. Yes, you can build a legacy, but if you only think about yourself and abandon ship in those first 25 years because you will only have $100,000 in your account and that is not even close to enough for a life of luxury, you have already lost. You have left the game because it is a generational game. It is a construction of generations' wealth. It was never just about being patient. Anyone who tells you to just be patient doesn't understand how the human mind works. It's about having purpose. And then there's the fourth mistake, that is neglecting opportunity cost. If I tell you that an investment yields 20% per year, would you say it's a good investment? You probably would. But why? Most likely you are comparing it to a common benchmark like the S&P 500, which historically returns around 10% per year. If 20% is higher, it must be good, right? What you need to understand is that an investment is only good or bad relative to an opportunity cost. Opportunity cost is the difference between what you earned and what you could have earned with the same investment of time or money. Always factor in opportunity cost when making investment decisions. Now, there's the risk cost too. If an investment yields 20%, but another similar investment with the same risk level yields 25%, you lost 5% in potential gains. If an investment yields 20%, but with double the risk of an alternative that yields 15%, is it still the better choice? Not necessarily, because you didn't factor in risk-adjusted returns. If an investment locks up your money for 5 years, while another option offers 15% annually with full liquidity, the trade-off in flexibility is part of the opportunity cost. So if you don't study options and invest in the first thing that seems like it will give you a return, you are also potentially losing money. And then it comes the fifth mistake, that is neglecting the Lindy effect. When you're thinking about long-term investing, not just for yourself, but for your family and future generations, you might look at the past 20 years and wonder, how can I invest for the next 80 years if in the last 20 we've seen the rise of the internet, social media, Bitcoin, artificial intelligence, and so much more? The answer is simple, by looking at the past. But not just 30 or 50 years back. You need to look much further in history. And this is where the Lindy effect comes in. The Lindy effect is a concept that suggests the longer something has existed, the longer it is likely to continue existing in the future. The name comes from Lindy's Deli, a restaurant in New York where Broadway comedians gathered in the 1960s. They noticed a pattern. The longer a stand-up show remained on stage, the greater its chances of continuing. In other words, plays and comedians who had already been performing for a long time tended to survive even longer. The Bible is a prime example. It's the most widely read book for centuries, meaning it is likely to persist far into the future. In contrast, a best-selling book from last year might be forgotten in a few years. So, which investments are Lindy's investments? Gold, land, businesses, and that's it. This should be the foundation of your portfolio for the coming years, or even decades. Buy gold, buy lands, buy stocks, or start your own business. And then the sixth mistake, neglecting inflation. Simple and fast topic now, inflation can turn a good investment into a bad one and make a bad investment even worse. If I offer you an investment with a 50% annual return, is that good? Well, actually, it depends. If we're in Argentina, where inflation in 2024 was 170%, a 50% return is a terrible investment. But if we are in the USA, where inflation was around 3% in the last year, then 50% is an incredible return. So never forget, investing without considering inflation is a huge mistake. And seventh mistake, sell cheap for the big whales to enjoy your loss. In the stock market, prices change every second, but the value of a company doesn't fluctuate nearly as much. Just open the stock market right now. You see stocks flashing green and red, moving up and down. Do you really think a company's value is changing that dramatically? Of course not. Yet, most people know the price of everything but the value of nothing. And in fact, you need to know the price to buy at a low price. Practical example. If I offer you my Patek Philippe watch now for $500, if you know the brand, you will buy it immediately. If you don't know the brand, you may refuse the offer. I'll give you some time to research the real price of the watch just in case, but it's the same with investments. When the price of Bitcoin drops, many people sell in desperation. But those who know and believe the value of this currency go out and buy it, hoping it will go up again. We've been through several cycles of Bitcoin. It goes up and down because the value hasn't changed that much, only the price. And why did I say all of this? Because you, the small investor, keep following the news and think that because you saw it right away, you are ahead of the game. Listen to me. When the news reaches you, you are already out of date. The big whales saw it much earlier. They wait for you to get desperate and sell at the perfect time for them to buy. Buffett, he started selling positions like Apple when the price seemed solid and stable. And people only started to notice his strategy when the war news started to get more heated. Oh, what do I do then, cousin? Remember when I said that those who don't think long term don't even play the investment game? You need to always invest with the long term in mind, in things that you think will last even after wars and crises. And to do that, you need to invest thinking about value, not price. In 2001, Amazon's stock plummeted from $113 to $6, but Jeff Bezos stayed focused on internal growth.
The stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way.
Metrics like customer base, profit per unit, and efficiency were improving, even as the market lost confidence. Bezos believed in long-term fundamentals over short-term stock prices. While investors panicked, Amazon doubled down on innovation, eventually becoming a $1.7 trillion company with over 300 million customers worldwide. Great companies aren't built on stock price alone. Anyone who bought for $6 got a great promotion. 80th mistake, investing based on timing instead of time in the market. A Bank of America study analyzed the S&P 500, the US stock market, since 1930. And here's what they found. The total return over this period is 17,715%. The return excluding the worst 10 days of each decade is 3,793,787%. The return excluding the best 10 days of each decade, only 28%, missing just the 10 best days per decade, turns what should have been life-changing growth into a practically nothing. A 70,000% return shrinks to just 28%. At first glance, it might seem like avoiding the worst days would supercharge your returns, but the best days and worst days tend to be close together. Many of the biggest stock market gains happen right after big crashes. If you're out of the market trying to avoid losses, you'll likely miss the biggest gains also. When investing, timing the market is far more important than trying to time the market. Well, that's it, cousins. Erase these mistakes of your financial life. Bye-bye and stay invested. Until next time.